G'day, welcome to the Financial Bloke Podcast, the podcast for people seeking the wisdom needed to grow their family's wealth and live a happier, healthier and more prosperous life. My name's Ben Law and I am the Financial Bloke. Growing your wealth is important, but protecting what you've built and what you might build in the future is just as important. And we quite often do that with insurance. And insurance is a really dry topic. You know, nobody likes talking about insurance. And for many of you, you might think, I'll tune out. I don't need to listen to something about insurance. But being a financial advisor for over 20 years, I can tell you that if you're going to grow your wealth, you've got to know how to protect it. And you've also, if you've got plans for the future for you and your family, you've got to protect that financial future as well. So getting insurance is important. Now, the number one important thing though, or not the number one important thing, but one of the really important things is that getting insurance makes sense, but getting it right is far more important. So the execution. And today I'm really pleased to have a good friend of mine, Chloe Arthur, with us. Now, Chloe's a financial advisor and an authorised representative of Findex, and she's based on the Darling Downs mostly, and she's an insurance advice specialist. Chloe's also a wife and a mum to two beautiful girls and a real professional. Now, I've known Chloe for a long time, and she's someone that I used to reach out for help when I was a financial advisor, as her technical knowledge is exceptional, and she's got more tenacity than should ever have been gifted to one human being. She's got a real no-nonsense, down-to-earth approach, and I think you'll enjoy and learn from our chat today. Firstly, I want to be really clear cut with everyone that I'm retired and I'm no longer a licensed financial advisor. So any information on today's podcast is just for general education purposes, and you should seek advice from a qualified financial advisor regarding your personal situation and not act on anything you hear today, except for go get some quality advice. Now, welcome, Chloe.
Thanks, Ben. Glad to be here.
Yeah, fantastic. And as I said, insurance is a dry topic, but it's one of those things that's really, really important. So we'll try and make it a little bit interesting today, won't we?
We'll try and make it fun as far as we can.
Excellent. Now, Chloe, just to get everyone to get a little bit of an understanding of who you are, I know I said you were tenacious before, and I'm guessing we're already going to know what your number one value is, but do you want to tell us a little bit about your number one value, why that's the case, and how it shaped you into the person you are today?
Yeah, sure. Look, it definitely is tenacity. I've always found that being persistent and being able to push those boundaries and make things happen is probably my greatest skill. I don't like to give up on anything easily. So very tenacious, very strong-willed, very professional at the same time. But I think that's really seen me go from someone who you can get things done or you can get big things done. And that's my key skill. Getting those big, complex, difficult things done easily. And
I've probably seen, because I know you personally, how you've implemented that for your family. And I'm going to give everyone a little bit of a personal story about myself at the moment. Just quickly, I have a bit of an IVF story. I've got a beautiful daughter, Sophie, who's 5-year-old, and we were told by numerous medical professionals that we weren't going to have children. It was just impossible. But both Sarah and I are pretty stubborn, and we got the opinion that impossible is just an opinion. And somehow, this would have been 9 years ago.
Yeah,
Chloe,
it would have been.
We got onto the topic of your first daughter, Matilda, and you'd mentioned she was an IVF baby and how much of a struggle it had been for you. And it was eerily similar to Sarah and my situation. And one thing led to another, and I confided in you, and you got yourself super wound up and helped us find the best IVF doctor for dealing with our issues in Australia. And 4 years and lots of tears and heartbreak later, we got our miracle baby. But planting the seeds of success was largely due to you, Chloe. And more than once, we almost gave up, and you were part of the refocus and helped us stay the course. So thank you. And I think, without that, seeing that tenacity in you and refocusing us, we possibly would have given up many times. So I'm eternally grateful for that. And I think that's what also makes you a really, really good financial advisor, is because you've got excellent communication skills and compassion coming out your ears. But as my grandfather would say, you've got more tenacity than a one-legged man in an ass-kicking contest. Geez, that was a Freudian slip, wasn't it? An ass-kicking contest. So I think it's really important in your job to have that tenacity, isn't it?
Yeah, it is. I think as a person, it's really important. And you're right, in more than one situation in my own personal life, tenacity has really helped me push those boundaries. And I wouldn't have Matilda, and I certainly wouldn't have Emily if I hadn't kept pushing. And was it easy? Absolutely not. absolutely heartbreakingly hard. It's probably the hardest thing I've ever done. 5 years of IVF to get Matilda, and it was worth every second. Don't get me wrong, but doesn't make it not hard, right? There's a lot of similarities between those situations and advice, because I don't think that the advice process is easy. Well, not when you do it right anyway.
Yeah, do it right. I think that's the key message.
Yeah, absolutely. There's lots of ways to cut corners. I'm definitely not one of those people, but getting it right isn't easy, and you need to be consistent and get the job done right through to the end.
Yeah, follow it through. Excellent, excellent. Now, when I was a financial advisor, I always used to call it wealth protection, because that's what it's doing, is it's protecting what you've built and also protecting, what you will build in the future and your family's financial future. So let's deal with farmers and graziers and business owners at the moment, because that's probably the most technical, I'd say. But why do you think you're seeing wealth protection or insurance being so important, and how do you see it, I suppose you'd say, Chloe, put in place?
Look, there's one other key component that you haven't quite touched on, and I think getting the wealth protection part right in the event of a claim in the future gives you time, and time is something that it's probably our most valuable asset in addition to building or protecting your own income and ability to earn an income. But time is something that we all need when we go through really difficult situations, particularly major health events. And insurance gives you that, because you don't need to worry about the financial aspect of going back to work, running the farm, doing this, doing that. You can employ people and have the resources at hand to do those things when you get this right. And you can give the people that are important to you the time, the commitment, and the help and support that they need, which I'm sure they'll be eternally grateful for.
Yep, absolutely. And if we look at it, I always say it gives you choices as well. If something goes wrong in your family, and it's usually, what you're covering is a health event, and that's whether you die, you're totally disabled or not able to work for a period of time due to a severe illness. It gives you choices. The last thing you want to do is have something go wrong and then having to fire sale assets or lose businesses or farms, etc., just because you couldn't get back in the saddle, so to speak.
Correct. Yeah, absolutely. We all work very hard, and it's a real shame when you see families lose assets, farms, property, equipment that have been in their families for generations purely because they didn't get this part right.
And if you think about it too, business owners and, let's say, farmers are in incredibly risky jobs. If you look at the number of farmers each year that are killed or severely injured on farms, the numbers are exponentially larger than any other industry. So out of all the sort of occupations, it's one that you really want to make sure you're covered off on.
Yeah, absolutely. Definitely riskier when I look at the statistics across different occupations. Definitely riskier in those sort of more remote. The more remote you get, the riskier it gets, unfortunately. And also the other one, Ben, is mental health. It's definitely tough. Whilst it is also physically risky, it's mentally risky, because some of the things that they need to deal with are quite hard.
Absolutely. Now, obviously, there's two ways you can protect your wealth. One, you can self-insure it. So if you've got enough assets to be able to pick yourself up if something goes wrong health-wise, or enough cash in the bank, etc., or enough equity in your position, but most people want to put some insurance in place at some stage. What are the major covers you actually need? And I want to put some context around this, because what you'll quite often hear in the professional capacity is, Dad's got some life insurance in place, or my husband's got some life insurance in place. We're covered. It'll cover some of the debt. But really, there's a lot more to protecting your wealth, because dying's just one of the things that might happen. So do you want to give us a little bit of a rundown really briefly on the types of cover most people get to cover themselves?
Yeah, sure. So I use the same cover for different situations. So using it for either personal or business is one and the same. So the first one's pretty easy. If you die, it's called life cover. You're dead, and your estate or the beneficiaries of that policy will hopefully get that money. The second one is total and permanent disability, which is pretty easy to understand. It needs to be total and it needs to be permanent. So you're never going to go back to work again. There are some complexities around how we structure those policies, whether it's your own occupation or any occupation that you could do. There's a few options, but essentially that means that you're not returning to work. And what that gives you is a lump sum of money to replace income that you would have earned clear debt, and provide financial security, essentially. Also, medical costs, those can be exponentially huge, particularly if you need to relocate from some of those regional areas where there's no access to good healthcare and things of that nature.
Today's episode is brought to you by AgriCoach. You've worked bloody hard over the years and you've built a solid operation. But as your children grow up and start their own journeys, you're beginning to think about the next 5, 10, and even 15 years and how to keep driving the business forward and ensure a smooth and successful succession plan. Preparing the business, preparing the next generation, and preparing for your eventual retirement all requires a solid plan and a proven process. Unsure about the right steps to take? Head on over to agricoach.com.au/webinar to learn more about our Succession Proof Your Family webinar. AgriCoach, aligning families, growing wealth, and protecting legacies. And now, let's get back to the episode. Because really, Chloe, if someone dies, that's financially probably much better than if someone's totally disabled. Because when they've passed away, they've gone, you move on with your life, you readjust. But if someone's totally disabled, they're there with you and it costs a lot more money and it will cost a lot of money until they pass away. And
there's a lot of variables. We don't know what's going to happen, when it's going to happen, how, where. You could be in Canada skiing for all I know and break your back. I don't know. So you're really trying to cover off on something that is not only going to disable you, but also, and I've seen this in many situations where, let's say the farmer is totally and permanently disabled for whatever reason, but the wife or family need to come in and actually help him to recover or help her recover. So you're not only losing one person, you're essentially losing two. And that can be financially devastating to a family. So TPD is what we call the abbreviated term, TPD, totally and permanently disabled. The other one is trauma cover. So trauma cover I love trauma purely because it's one that I pay a lot of claims on. It covers us for things like cancer, heart attack, stroke, a lot of neurological conditions, so things like Parkinson's, where there's 46 conditions. If you meet a condition of release, you get that money into your bank account as a lump sum. You can do whatever you want with that, and it's tax-free. So those policies are very, very beneficial at claim time. And, of course, income protection. That one's, been around for a very long time, and most people would think that they have income protection. I hear that a lot. I have it. It's under my super. Income protection replaces your income if you can't work. Now, that can be permanently or temporarily. Could be 6 months, for example. It could be 10 years. It could be 20 years. I don't know. So income protection is a really, really good policy to have in place if you need your income to live.
Yep. And the last one, which you quite often see in businesses more than anything, is business expenses, being able to cover some of the business expenses if something happens to you.
Correct. So if you think of what your fixed costs are without producing any income, so things like lease repayments, electricity, phone bills, repayments on land or property, those things can be covered off in an insurance policy. So what happens is if you go on income protection claim, so you can't work, your business expenses policy will pay those fixed costs for you for a period of time, and that's generally about 2 years.
Yep. And it's interesting, trauma, Chloe, is probably the one, and you'd see this yourself, which I found really interesting over time, was it is the most claimed. I think is it 1 in 3 now or 2 in 3 now will generally have what they call a trauma by the time they're 65.
Yeah, I think we're definitely trending towards the 2 in 3.
The 2, yeah. So it's at least 50% of people will have a trauma, and like we said before, it's heart attack, cancer, stroke are the major ones, aren't they?
Yeah.
So we think about things like breast cancer or melanoma. I mean, I've had back in my career, I had some breast cancer claims, melanoma claims, and a multiple sclerosis claim. So there's claims that people can actually get, and what it's designed to do is to be able to pay some medical expenses. Because if you look at People sort of think, well, if I'm dead, it's a major impact. But if I get cancer, well, I'll just battle through it. But they forget that things like, the best cancer drugs at the moment are about $3,000 a month, or that was, a couple of years ago, $3,000 a month to pay for.
Absolutely.
Plus, if you live remotely, you've got to go into town for treatment. You're away from the business. The costs just keep adding up and adding up and adding up. And so that's just a really good way of stemming the flood of money out the door, so that your whole farming business or your business doesn't just fall over.
Yeah, correct. Your focus will definitely shift. And although we like to think that we can do everything, unfortunately, when these major events occur, we realise that that's not possible. So you're right. Trauma is a cover that was primarily designed to pay for medical expenses. They're not cheap. They are going to be higher than what you think they're going to be. But at the end of the day, if you can get good access to treatment quickly, we all know that the outcomes from that are a lot better in terms of longevity and recovery and ultimately staying alive.
Absolutely. And so, Chloe, one of the things that I see is debt's usually the main driver for most people who are in business of any sorts. So they want to cover those debts. Generally, if you're running just a normal business, you've got debts. If you're running a farming business, you've probably got significant debts, and that's the big concern for most people. So they're recovering their debts, but they're also in business. There's things you need to cover other than that, like buying out a business partner, etc., replacing revenue or replacing people in the business. Do you want to unpack that just really briefly, just a little bit for us?
Yeah, sure. Look, while debt is important and we always cover off on debt purely because it needs to be addressed, it's much deeper than that, Ben. When you are in business, depending on how you're structured, if you are a partnership, then you are, by nature, you are both liable for any debt, whether that's business or personal debt that you actually carry, and making sure that you have each other's backs in partnership and in business is really, really key. So there's partnership cover, there's business insurance cover, and business insurance cover is where, let's say, Ben, you and I are in business together and something happens to you. I'm going to pick on you, why not?
Yep.
And you have passed away or you become totally and permanently disabled and you can no longer work in the business. That's what we would call a trigger event. At a trigger event, we would have a legal agreement in place that says what's going to happen. Now, the insurance rides side saddle to the partnership or the business agreement, and it will ensure that when that is paid out, that Sophie and Sarah and yourself will receive the money. But your share in our business, so that 50% share that you hold, will be transferred to me or to my family trust or whatever structure I've got. So that I will maintain control of the business. I now own it 100%. You will go on your merry way, get better, recover, and go on to do whatever you're going to do in the future. Otherwise, if you don't have that in place and you pass away or you aren't able to continue operating in the business, you still own 50% of it. You are unable to contribute to it. And if you pass away, I'm going to end up in business with Sarah. Now, I know you and Sarah pretty well.
And she might be tough.
I would rather be in business with you. Yeah. She's definitely going to be tough, but she's not going to have the skill set that I'm going to need to continue my business, right? And that's going to be detrimental. You don't work so hard to get where you are to have it lost purely because of poor planning.
Yep. And also replacing those key people in the business is really important. Yeah. I mean, I use the example of, let's say you've got an engineering business, and you've got one of the business partners is a salesperson, the key salesperson that brings in all the revenue, and the other one might be the person that's back at the workshop making sure things get produced, quality control, etc. If either of those die, that's going to have a significant impact on the business, isn't it? So, in other words, your key person with all the accounts and in the sales drop off the cliff. What are you going to do? They may not be easily able to be, replaced. Same as your key engineer in the business. If something happens to them and they die, the salesman can sell all he wants of whatever you're producing, but if you can't produce them, you've got no business. So replacing those or having cover in there enough to be able to replace those key people and the revenue is just critical, isn't it?
It is. If you think of the people in your business that would have an impact if I took them or removed them from your business tomorrow, instantly tomorrow they're gone, and you go, wow, that would really impact our business financially, we need to consider those as key people. Now, they can be directors of the business. They can also just be employees, right? A lot of your employees are there or have even been there for a long period of time. So there's trust and goodwill that is built into those relationships. And when they go and people start questioning whether or not you can produce that item or deliver that service, you'll lose business because they will go elsewhere. So covering off on that is absolutely critical in a good plan.
And the last one I thought of too was just that, and we talked about this the other day, was the equalisation of an estate. Being able to have the children that aren't in the business balanced out with a life insurance payment as well. That's pretty important, or a way that some people equalise their estate.
Yeah, true. So you can use insurance or other methods for this one. Insurance is good because it's very cheap and it can stay in place for a long, long, long time. So most life insurance policies now don't actually lapse, so you will keep them until you die. And when you die, there will be a specific policy that, again, with the right legal work in place, will go to that child or children who aren't retaining any on-farm assets. That will then mean that, for example, we've got a farm worth $10 million and that's going to go to their daughter, and their son's in the city and he's become an engineer. And he's not going to take any part of that estate. Well, we would go, all right, daughter has a farm worth $10 million. The son needs equal value or whatever value that they're going to put on him having. Might be 10 million, might be 5 million, whatever the number is. And we put a life insurance policy in place. It will go directly to him in the event of a claim. He'll receive his money. And then as parents, we know that we have been able to equalise the estate assets.
Absolutely. And because traditionally what happens is, the one child may take over the farming business, and using those numbers, it's worth $10 million. And the estate basically says, well, if mum and dad pass away, you've got to pay $1 million or $2 million or $5 million to the off-farm sibling, in this case, the son in the city. And that could end up making the farm unviable or not working. So it's a way of doing that, and also potentially stopping squabbles within the family. I mean, it's obviously you need to get really good legal advice and really good structuring advice, but it's a way people have used it in the past to balance that out a little bit.
Yeah, correct. And more importantly, you can create some certainty today that then your children don't have to deal with the ramifications of later. So having those conversations, having the right people and the right team, I think that's really critical to any farmers, graziers and businesses, is having the right people to put this stuff in place, to have the tough discussions, because these aren't easy things to do and talk about. But once you've done that and you've got it all in place and you regularly review it, come claim time, your children aren't going to be at each other's throats. There's not going to be people coming at your estate from left, right and centre, because you know as well as I do that those things go pear-shaped very quickly, and a lot of families and children don't recover. Their relationships are lost, and I think that's really, really, it's really sad.
It is, yeah. And the thing is people expect their children to behave rationally when they pass away. But it's like births, deaths and marriages seem to bring out the worst in family. I mean, we've all heard the stories of having a wedding and it might be the father-in-law's the father-in-law Godzilla, or the bridezilla or something like that. And then when people pass away and emotions are high and money's floating around, and this is really, really clear in the farming space, because you see one or a couple of the family members getting this farm worth a lot of money and the others getting less or not as much. Correct. So it becomes a really emotive thing. And the lawyers love it. I mean, especially when it comes to estate challenges, is the estate pays all the legal costs. So the nefarious lawyers, or the ones that we don't really want to be dealing with, they're the ones that see that there's this massive amount of money, so they come in there and try and get what they can. But I suppose what I'm trying to get at is that it's a way of doing it. So the other thing then, Chloe, is, like I said before, doing it right, having cover in place to, cover your debts or your income or your expenses, so your family's protected and the business doesn't fall over, or you have to fire sale assets, is important, and having the right cover, but also structuring is important. And I think this is the absolutely most overlooked part of when people are putting their insurance together. And as an advisor, I used to see this continually wrong all the time. It'd come across my desk, I'd see it, and you just shake your head at how bad it was done. They had cover in place, but the structuring was wrong. So can you talk me and unpack a little bit about structuring?
Yeah, sure. The structuring part, I don't think I've ever seen a deal come across my desk, Ben, where it's right, to be fair. And that comes about for a few reasons. One is because you need specialist advice to get it done right, and that does cost money. I get that. Having an accountant and a specialist lawyer, not the guy down the corner that does wills and estates. That's not what I'm talking about. Having the right person with the right business acumen to understand structuring. And I know that might sound simple, but unfortunately it's not. Structuring isn't a simple conversation because when I go to put the insurance contracts in place, what we're trying to achieve is to get the right amount of money into the right hands at the right time. And whilst that sounds simple, you don't want to put the money into the wrong entity where there could be major tax implications. We don't want to give the wrong amount of money to the wrong person when we could structure that better and account for, again, tax and provisions, and also CGT. That's a massive one as well. So what I tend to do, Ben, and I know you've done similar in the past, is I like to get the right people for that family or that business and actually put them at a table. So I will bring in Russell or Brett, who are our accounting partners, or one of the managers that they're working with, and I will bring in the lawyer, and I might bring in the financial planner and whoever else I need that's pivotal to that discussion. And we will have a open chat around how we're going to put this in place, both from a insurance point of view, from a business point of view, the key people we're wanting to cover, what's going to happen at claim time, and what entity is best owning that cover, so that we aren't paying too much money in tax, so that we are getting the right cover in place. Sometimes we'll bypass estates and sometimes we won't. That's a big one. We will often see that there's money being left, $2 million being left to their estate. Okay, what does that mean? If there's no estate documentation in place, then somebody else is going to be making the decision as to how those proceeds are distributed. And that, at the end of the day, is what we want. What we want to do is create some certainty, pay as little tax as humanly possible. I think we'd all agree that that's high on our priority list, and make sure that the right people are getting the money for whatever its intended purpose.
You just raised a really important word, Chloe. I think that we need to just go back and just restate and then move on, is certainty. I think that's the most important word here, because if you're going to spend the time, effort and energy getting this right, you want to have absolute certainty, or the most certainty you can possibly get, that the right outcome is going to happen, or the outcome you need is going to happen if you have what they call a claimable event. And so that's, which is just critical, because the last thing you want to do is half-ass it and then all of a sudden get to a claim time and your husband or your wife goes in or your family goes in and says, oh, we've got this policy, and say, sorry, no, you're not going to get that $5 million loan cover insurance paid out, or you're not going to get that $500,000, or sorry, it's taxable, so half of it's going to the tax department when you didn't expect it. So I think that's really critical, is getting that certainty in place. But just to go back a bit, structuring, I think we might have used a bit of technical jargon. I don't think I explained it really well, but structuring is what we're talking about, is who owns the policy and where the money gets paid. So is it in your own name? Is it in a company or a partnership or a trust? Is it in superannuation, etc.? So it's how you structure those products so that the ownership's there and who the money gets paid to. That's your understanding, isn't it, Chloe?
It is. An insurance policy has to have an owner and it has to have a person that it's insured. They don't have to be the same. It also needs to have what's going to happen to the money at a claimable event. So they're the three components in the structuring process that must be right. And that will fit into, as I said, the existing relationships and stuff that we're trying to cover. But if I go back a step and I come back to certainty, it gets me really quite wound up, because there's two components that have to be right. The first one is the structure of the cover. So we do that in what we call advice. That's what I do. I give advice on how we're going to structure those policies based on what you need to happen.
And sorry, Chloe, just to really quickly, and you need yourself and your accountant and your lawyer there in many cases to be able to make sure that's done right, because no one person has all the answers, do they?
They don't. No, absolutely not. As a team, we can get it right, but I absolutely cannot get it right on my own. And whilst it seems like it's probably a little bit more difficult to do it this way, and it is, and it absolutely is. This isn't an easy process, but it is a bit like IVF. It's absolutely worth every second when you have a smooth claim at claim time when the family or the person is already under a tremendous amount of stress and pressure. We relieve that pressure at claim time and go, right, we've done the work. This is done properly, and out go the proceeds to the right person, right entity at the right time.
So the other thing I'd just like to touch on before we go on, Chloe, is another thing which people don't talk about, but I think it's worth mentioning, is the fact that if something happens to you and the money gets paid down to your family, and so the last place you want it to do is go straight to the bank. You want to be able to have the money come to you, and then you have the choice how much to give to the bank to pay down debt and not. The last thing you want to do is the bank be able to gobble the whole lot up to give you a choice. So I think that's really important as well. And that's part of the structuring, making sure it doesn't go straight there. Isn't that right,
Yeah,
Chloe?
absolutely. So we all think that the money's going to go straight to our family because that's what we think it's there for. Unfortunately, if the money goes straight to an estate, then the bank gets a first chop at it. And that's not what we want. We want to make sure that you have got choice and you've got time on your side to make those decisions without any financial pressure. So what we do to stop that from happening is making sure that if we don't want the bank to get their hands on it first, is we will actually nominate a person or an entity that money is to go to, so it bypasses the estate. So it won't just land there and be dealt with in a will, or sometimes if a will doesn't exist, that's where the banks can get it quite quickly. It will actually go directly to individual people or an individual structure where it can be distributed. And then the people left get to make those choices. It's about choice.
Which is what you want. And so the next thing is so if we've got we need some cover and we've worked out what cover we need, we know we've got to structure it appropriately. The next thing I want to touch on, which very few people know about, you will if you've gone through insurance, but it's underwriting and why it's so important. So do you want to run us through that, Chloe? Why underwriting? What is underwriting to start with, and why is it so important?
Okay, underwriting is where the people, so in this case we will use insurance so it makes sense. Underwriting insurance means that they are going to gather all of the information about you, whether that be health, medical, structuring, all of that information. We package it all together and we give it to humans. And those humans are called underwriters. And they look at the information and decide whether or not their business, so the insurance company, would like to take you on as a client. And what they look for is risk. So occupation, your health, your finances, how risky are you as a person and what are they willing to take on board or not? So if I took you, Ben, and I wanted to go and get you insurance, we would have to go through the application process. We'd have to put it all together. We'd submit it to the insurer and then they would decide. I do things a little bit back to front, but bear with me, I do it for a reason. I underwrite very heavily up front. And the reason I do that initially with you rather than leaving it right to the end is because I don't like to give anybody nasty surprises. I don't want to take you through a difficult, complex, time-consuming process if I don't believe you're going to get the insurance anyway. That's just wasting your time and mine. And I try to eliminate that as much as humanly possible. But again, we're all human. Things come up. You might go and get a blood test for insurance and something comes up in that blood test that you don't know about.
Because you can't just get insurance, can you?
Well, you can, but when we go back to talking about certainty as we were before, if you just get cover off the TV or it's under your super and you never applied for it, it's been essentially gifted to you and it's not underwritten. They don't look at whether or not you are the type of client they want. What they do is they look at underwriting at claim time. You can underwrite at application to provide certainty, that word again, or you can underwrite at claim time and cross your fingers and toes and just hope for the best. They're your two options.
Because when you underwrite, the insurer can come back and say, yes, we'll cover you, Chloe. No, we won't. We just see you as too high a risk for various reasons. It's generally health related. We see you as too high a risk. And at least at application stage,
Correct.
Because they may come back and give you what they call a variation of terms, can't they? Or modified, where they can come back and say, look, Chloe, we'll cover you, but you've got a busted knee. So if we may not, or a busted back, we're not going to cover you if something goes wrong with your back. They'll do an exclusion.
Yes.
It's better to know that up front than at claim time, because there's nothing worse than getting to claim time, going into the insurance saying, hey, we'd like to make a claim, and them saying, sorry, we're not going to pay you, which with underwritten at claim times means they can actually... They can be biased about it, can't they?
They can. And in that situation, you are never going to be paid on the back. So whether I underwrite you up front and do all the hard work and provide certainty, or I wait until claim time, you're not going to get a claim on your back if it's pre-existing. So they look at all those conditions. You're right. They can either have two decisions. They can exclude parts of your body and your structure from cover, and the wording on that is very specific. Or they can say, all right, we're happy to cover you, Ben, but you know what? You've had a few issues with your back. We are going to charge you a little bit more if you want cover for your back. And sometimes you get a choice. You can choose to pay more money to have your back covered, or you take an exclusion.
And it's interesting. I think of it just like, say, a Land Cruiser. Imagine if you went and bought a brand new Land Cruiser, or let's say a truck. You went and bought a brand new cattle truck, bought it home, or a tractor, bought it home, rang the insurance company, says, hey, I'd like to insure my truck. And they go, yeah, no worries, here it is. And then when you went to claim, when you had an accident, you went into the insurer and went, oh, yes, we've got a Hino truck. And the insurer goes, we don't actually cover Hino trucks, sorry.
Yeah.
I mean, it just makes no sense, does it? It just makes no, or you've got a John Deere, sorry, we only insure Case IH.
Yeah.
I mean, it makes no sense. It's the same with yourself. You want to know that if you're going to pay this money and go through it, that you're actually covered. But people invariably will take the easier route, which is the whole, oh yeah, I'll just get it off the TV or through my super fund or something where I don't have to do too much effort.
Yeah, absolutely. And inevitably in those situations, Ben, someone always ends up paying. You either pay the price to get good advice and put this stuff in place early before something happens, or you pay the price at claim time. Your claim can be rejected. You won't get the right amount of money if we haven't accounted for tax. The wrong person can get the money, or the wrong entity. All the money might go to the bank. Your claim might not even be paid. And yet you've been forking out all this money for, and I've seen it. I've seen it happen to real people in real life situations. The other thing I specialise in is claims. So hence why I keep talking about claim time, because that's when the rubber hits the road. That's when we go and get your money.
Exactly. And the problem with it is I've always observed is the average person doesn't know how good a job the advisor's done that's put the insurance in place until it's claim time. And so you may never claim on your insurance. You might claim 15 years later, and that advisor is no longer working for that company. You know, the banks are a great example. You know, there were lots of advisors out there giving advice on insurance, and now the banks don't do advice. Those advisors have all gone, and you're not going to know whether a good job or a bad job was done. And the interesting part is what I've found over the years is so often I've seen people have got a really, really bad setup. Not because they did the wrong thing and they cut corners, etc., but a lot of the time it was from really bad advice. And I can think of one at the moment just off the top of my head is someone I saw years ago who they had two $4 million life insurance policies on Dad for the farming debt. And they said, we've got $8 million worth of cover. We're really happy. Everything's great. And it was with two different insurers. And I remember the accountant actually said to me, you know, Ben, we need to have a look at this and review it. And Dad said, oh, you know, I've got $8 million worth of cover. What are we even looking at this for? It's a waste of time. And short end of the story, Mum said, have a look, Ben, and just check it out. And I went into it and found out that they actually had $4 million worth of cover, because when the second lot of cover, the second policy for $4 million was put in place, it was on the proviso that they cancelled the other one. So even if he did pass away, one of them would not have paid. they would not have paid, and it was in writing. And you see that stuff all the time where it's just sloppy advice or sloppy implementation.
Correct.
And the other thing is that straight away we want to blame the insurers. And don't get me wrong, I'm not always a fan of insurance companies. I mean, their job is to make money for their shareholders. But in a lot of these situations, it's not the insurer's fault. The insurer's just doing what they do. They have their laws, they have their guidelines. It's in black and white. It's just that the people that put it in place either didn't know, didn't care, or were just stupid.
It could have been as simple as, oh, sorry, I forgot to cancel that other policy.
Yeah. Yep.
Well, you know what? That doesn't cut it. It is a complicated process to get through, and that's why you need good people on your team. And you need to be pretty committed. It's not just up to good people. I think we need a certain level of responsibility over what we all hold ourselves. I mean, I do. I know what insurance I've got, where it is, what's going to happen at claim time, because I've seen, I live and breathe this stuff. I don't want to be one of those families where, as you said, 8 million becomes 4. I have 2 little girls to protect. So we do have to take some personal responsibility and make sure that these things are right and that we review them. It has to be reviewed. It is not a set and forget. I like to tell people that up front, because you can't just put and invest a lot of time and money into these policies to then just let them sit there and say, oh, she'll be right. She won't be.
And I think do it up front right, and it substantially reduces the work later on, doesn't it?
100%.
I mean, if you get it right up front,
Yep.
And there's never going to be that uncertainty that, gee, what happens if this doesn't actually pay out?
Yeah, absolutely correct. If you do the work, you do it properly, you have certainty. And I have a saying, when you know, you know. And until you know, you don't. And once you've been through the process that I go through and getting all this done, you will know with certainty that you are covered, what for, how, what entities own what, and you will have confidence around the team that has put it in place. Now, whether or not that team exists at claim time is then irrelevant, because if you do the job right up front, anyone should be able to pay that claim. You still have to review it. I'm not saying you don't, but I would be able to hand a client to a colleague and say, look, I'm on annual leave for 3 months and this family needs some help. Help them because I know I've done my job properly. And that's really important to me as a human being.
Yep. And banks like to see you have insurance in place. It gives them a lot more comfort. It takes one of their risks away.
Yeah.
They because they know that if something goes wrong, they're not going to have to knock on your door. And we quite often kick banks and we love giving banks a hard time. But the reality is they like to see it in place because it protects them, but also nobody wants to go around and knock on a widower's door or a widow's door and kick them off the farm or out of their business or their home.
Absolutely
because
not.
There's no cover there in place.
No.
So I think it's a smart thing to do. Now, there's a couple other things I just wanted to mention and just get your really quick feelings on this is old policies. Mm-hmm. I've had this policy in place for donkey's years. Things change, don't they?
They do. Insurance contracts acts change regularly at the moment, more so than ever. Policies get upgraded. They don't always pass that back to existing policy holders. So whilst we think, for example, that you're covered for early stage melanoma, you may not be. You may think that you have got cover for, breast cancer. And I know, Ben, you've had a case where the client thought that they were covered for breast cancer, and they were, provided they had a full mastectomy.
Yeah, that was a really interesting one. It was one we fixed up, but I remember when she was diagnosed with breast cancer, and it was very aggressive at this time, and I remember they did a lumpectomy. So they just took the lump out, and then she went and got chemotherapy, etc. And I don't remember all the specifics, but what I do remember is I went back to the old policy just for curiosity's sake, and I read the definition, and it basically said, we will only pay you if you have a mastectomy. Now, you might look at that and go, that's crazy. But back when the older policy was put in place, 10 or 15 years before, that was common practice. If someone had a breast cancer, they got a mastectomy. So that was an easy way for the insurance company to say, oh, well, if you've had a mastectomy, it's aggressive enough.
Yeah.
But times had changed, and you can imagine you go in and say, oh, sorry, we're not going to pay you because you didn't have a mastectomy.
Yeah, the insurance industry and insurance contracts have been very good at aligning with the medical treatment and processes that are available in Australia. So, for example, that's a great one because now you don't have to have a mastectomy. You don't have to actually get treatment. It's about choice. If you are diagnosed with cancer, and there's early stage and then there's full cancer, don't get me wrong, there is a difference there. But if I'm diagnosed with breast cancer and I don't want to receive treatment because it is terminal anyway, and that's my choice, I'm still going to get my money. And old contracts in lots of areas, they're all different. Potentially in old contracts, I wouldn't have got my money. So sometimes they're worth reviewing. I'm a very big believer in if it's not broken, don't fix it.
Which is important.
Yeah, I
think so.
I don't swap and change policies just for the sake of it. I have plenty of things to do to keep myself occupied. But if there's a really good reason, and it's important that we look at it because I feel like it's going to be better and provide more cover, and if particularly if breast cancer is something that's important to them, then I will change it.
Yep, of course. And then there's the old things that you see that get excluded as well, which I've seen plenty of times, is things like horse riding, risky pursuits, they call them. So things like horse riding, flying, climbing windmills, climbing silos. If you're a farmer or a grazier, you're going to be doing a lot of those. And so some of the old policies, I remember when I first started financial advising 20 years ago, I had a look at a policy my dad had, and he couldn't ride a horse, couldn't ride a motorbike, and he couldn't use a chainsaw.
Crazy, right? So if we don't tell them about those things, and you may be sitting there thinking, oh, look, I don't want to tell them because they're not going to cover me for that. Well, they're not going to cover you for it at claim time anyway, if that's what ends up injuring you. So again, I flip that on its head and go, you know what, let's disclose everything. Let's tell them what you actually do. And a good example of that is I had a farmer who had massive silos, and he had actually built these particular silos, and the way that he had built the inside essentially had a footpath on the inside of the silo, and it had a rail on it. So he was a father to 4 small children. So it was actually quite safe. When I went on farm with him, I took pictures. Well, I didn't. I got him to take pictures because I wasn't climbing the silo, but I got him to take pictures of it, and I submitted those to the insurer, and I said, I understand that this is risky and I get that. However, I'd like you to actually have a look at the safety measures in place. And we ended up having that noted on the policy that he was fully covered.
And if someone fell into the silo or he fell in and died, the insurance company would pay out, whereas normally they wouldn't. The other one too is the mustering. That's the one I used to find would sneak up is, oh, do you fly? No, I don't fly. I don't have a pilot's license. And it's like, okay, well, you get mustering done once a year or a couple of times a year.
But they'll still go up.
And you'll go up in the helicopter. Oh, yeah, I usually fly them around to show the paddocks. Well, a lot of insurers says, yep, we'll cover you, but a lot don't. And so it's being able to, like you said, explain what it is, let the insurance company know, get that noted on file, and then if that helicopter does fall out of the sky and you do die, your family's covered. There'd be nothing worse again than that happening the one time you went up in it and then family missing out.
Yeah, look, and we aren't, as I said, we don't know what's going to happen or when, and you can't know every single thing that every person does in, every situation. But what they look at is whether or not, for example, I've got insurance cover, and if I decided tomorrow to go up in a plane with someone, well, that's okay, because it's not something that I would have been deemed to regularly have done. If they had regularly done it and not told them, that would be an issue.
Yep. And if you're not doing something or you have never done something at the time you make the application, if your situation changes after the policy's in place, it's not a problem, is it?
No, that's correct.
No, but it's all about intention and proof. So I always say it's always good to note it on the policy up front. So then there's no wiggle room for the insurance company to get out.
No, and again, all up front. So they get one chop at making a decision about the client based on the information at hand at that time. At the time you apply, not at the time you make a claim. That's the key difference.
Yeah, yep. And another thing we talked about the other day and I noted down was the whole, dad's insured. Mum, we don't need to get mum insured.
Mm. That's a common one, Ben, and I must say that I find it quite difficult because if something happens to mum, I know I've had 100% of my claims where something has happened to the female partner or partner, let's say breadwinner, if you like, or the person that is actually physically doing some of the jobs or is the key person in producing the income, will have to come and support her and the family and the children. Bar none. That 100%, it is probably the one thing that most people don't anticipate. And we can insure against that. The right people, the right structures, thinking these things through as to what would actually happen at claim time means that we can absolutely protect you against that loss in income, both for her and for yourself and for him.
Because people forget, if you using the general terminology, if mum gets breast cancer, generally she just doesn't go into town, have an operation and then come home. It's extended time away. There's kids, there's debt still to be covered, all the farm or the business still has to run. Everything has to stop. Absolutely.
No, it's very uncertain time. We don't know if mum's going to pass away. We don't know how long. We don't know what treatment options. I don't know if I'm going to fly you to New York to get stem cell therapy. I don't know what we're going to do. So giving you time, and I said that at the beginning, these things should be put in place to give you financial freedom, so take some of that pressure off and allow you time to make the right decision for your family. And I can't tell you how important that is at claim time.
And because the last thing you also want is you're going to be going through a very, very stressful time medically and relationship-wise with your family. The last thing you want to do is dump on top of that a whole lot of financial uncertainty and stress as well, because nobody's going to get well and healthy if they're over the top stressed about money.
Absolutely not. They are linked. They are proven to be intrinsically linked to good outcomes. Yeah. And we don't want to make anyone else sick in the family. Something happens to my husband, well, guess what? I know that I'm now going to bear the load of the entire family, and that's incredibly difficult. So making sure that there's some resources to take some pressure off the right people at the right time, and you can fund that. You can bring in a nanny. You can bring in another key person to the business to replace some of that income. There's lots of things that we can do if we think about it.
If you've just got the cash to be able to do it. And I think that sort of ties into the affordability discussion in the sense that insurance can be quite expensive. Yep. It can be cheap for some people. It can be quite expensive as well. So it's knowing, like sitting down and working out what cover you need.
Yeah.
And then if it doesn't fit the budget, it's then adjusting your expectations and then having a plan in place for if the worst happens.
Yeah.
And the gap between what you need and what you put in place is self-insurance, isn't it? And you need to know what that is. So it's almost like saying, well, if I get totally disabled, this is the plan and this is how we're going to fund it. And you might partially fund it.
Yep.
You might go, okay, well, I need $1 million worth of insurance, but I'm only willing to spend enough to buy $500,000 worth of cover. And because that's the case, I will sell some other assets or, whatever it might be. It's that self-insurance, but you need to know what it is, don't you?
Well, you do. And the great thing about having those discussions, even though we're only talking about insurance, inevitably what happens by the end of the process is that there is a plan in place. And please remember that strategic advisors aren't there to sell you insurance. They're there to strategically ensure that you're protected. It's a very big difference. So whilst we have said that, okay, we're going to insure $500,000 for these particular areas, we have now communicated to the advisor, to the accountant, to the lawyer, and to the family what is going to happen by not insuring the other 500,000, and that brings another level of certainty to the conversation, so that when the gun goes off and something happens, they don't expect $1 million, because we know we've had that discussion that it's only going to be 500,000, and that it's now time to put that particular property on the market, or let's go and lease out that piece of land, or those 3 tractors need to be sold off right now. And that's okay, because the reason we're going to do that is to save the other farm assets.
Yeah, absolutely. And then that's the thing is I always used to find people were all or nothing. Oh, insurance is expensive, so I'm not going to have any. Well, no, that's not the right way to go. It's like saying if the tractor was all your machinery is too expensive. Well, insure your most valuable machinery. Don't go insure maybe the welding rods, for the lack of a stupid example. Like,
let's insure the dog.
Tractor.
Yeah.
Make sure you insure what's right. So
Yep.
it's there. And I think the other thing is getting in, just where we'll sort of round this off because we're running out of time now. But I think making sure you get the cover in place when you're young is so important, isn't it? Before your health changes, because
Absolutely.
if your health changes, and let's say you get to 45 and you have a heart attack, you might be uninsurable. And it's going to get more expensive as you get older. So starting early is really important too, isn't it, Chloe?
Yeah, it is. It's cheaper when you're younger. You have good health, so you can actually get the cover. The easiest way to have a claim is to have one policy in place for a long time, if it's the right policy, of course. So critical. It's also critical to getting people to understand the complexities around insurance, and that having it's not a bad thing. It's a good thing.
Yep. And it's like any insurance. We hate paying it. We absolutely hate paying it.
Oh, me included. I don't love my insurance premium bills. Nobody does. But I do value it.
Yeah, we've got to value it. And I think, we don't value it until we claim on it. And I remember, just to tie this last bit off, I remember someone saying to me years ago, they said, Ben, I've got to get rid of this insurance policy. And I said, why is that? They said, I've never claimed on the bloody thing. It's a waste of money. And I remember I laughed out loud, and to start with, they looked at me as if I was a weirdo. Like, what are you laughing at? And I said, well, if you haven't claimed on your insurance policy, that's a bloody good thing. And they said, why is that? I said, well, you're not dead, you're not totally disabled, and you're not all screwed up medically.
Absolutely.
And they looked at me and went, oh, yeah, you're probably right. We've probably won, haven't we? So the goal is never to claim on your insurance.
Yep.
It's not about winning or getting something. It's about stopping a catastrophic event, pulling the whole deck of cards down.
Absolutely it is.
Yeah. So, okay, Chloe, that's great. I mean, obviously, we could talk about this stuff for days and digging into it, and we've absolutely scratched the surface. But as I said, it's not that exciting a topic to talk about sometimes.
Not for others, no.
No. We enjoyed it. So what are two things people can do after today's discussion, I think? If you're sitting at home, you're listening to this, you're going, geez, I need to have a think about this. What do you reckon are two things they could do straight away to at least start to move them in the right direction to getting their wealth protection in place all right?
Yeah. The first one would be to have a discussion with their partner, with themselves, with their children, have an open discussion around whether they think that they need a review. And that could be amongst themselves or with professionals. And the second thing is to have a look at what you've got. Get it out. Go searching, find the policy documents, ring the insurers, find out what you actually have and start thinking about it. Of course, if you need to reach out, you've got my details, and or find good quality advisors that can help you. That part's critical.
Yeah, and make sure they work with your accountant and your lawyer. Yeah. They're collaborative and they specialise in it, because it is a specialist field, isn't it?
100%. I'm very busy being a specialist purely because this isn't a job that a normal financial planner could take on.
Yeah. Generalist, because it's very specialised. And it's funny, Chloe, I think the whole allocate some time to do a review yourself and pick all your documents up. I always say do a simple spreadsheet and just put everything in there, because worst case scenario, if something happens to you, someone can find that and say, oh, this is where all the policies are.
Yeah, look at that.
Add them up. That's a really good motivator to do a review. If you've got policies in place, add them up, see how much you're spending. And usually people are not shocked, but they don't realise what they're paying altogether. Yeah. And when they start seeing what they're paying, they go, geez, this is probably worth making sure it's right.
Absolutely. If you're going to invest in it, please make sure it's right.
Yeah.
Yeah, come claim time, we want to make sure that you are actually really well looked after. That's the goal.
Excellent. Righto, Chloe. Well, that's been absolutely fantastic. I've enjoyed it immensely. So to end us off, as I do with everyone, what's your definition of true wealth?
Time. Having the time to make the right decisions for me and my family.
Yep.
It's not
fantastic.
It's not money for me. It's definitely, money does buy us time. It does. But having all of that locked and loaded, ready to go, definitely not being under pressure.
Yep. Well, what is it? The financial security or building your wealth actually gives you more time and more choice.
It does.
Yeah, it all ties in together.
Yeah, absolutely.
Fantastic. Excellent. Righto then. Well, thanks very much for that, Chloe. And yeah, we might have to have another discussion about something a little bit more in depth later on down the track.
I look forward to it.
So today, I just want to give you a really quick summary of what I think are the key points we need to be thinking of when it comes to insurance. Now, the first thing is insurance is just one mechanism for protecting your wealth. You need to be thinking about your estate planning, your asset structuring, or the use of companies and trusts and super, etc., to protect your wealth, and also the contracts and partnership agreements you're involved in. It's just one mechanism to protect your wealth. It's only useful if it's done right. Underwriting has to be done at application time, and it needs to be done properly. I can't stress that enough. You don't want to get to the end of getting to the point where you're going to claim and then find out, the insurance company's not going to pay for some reason. It's really important that's done right. And that is the number one thing I used to find when I was an advisor, is I'd go through old policies and find out that it hadn't been done right by either a sloppy advisor or just someone had done it themselves and didn't realise the implications of what they'd said on the application policies. Next, ownership is really important. So just because you're the insured person doesn't mean you're the owner. Your super fund or a super fund could be the owner. It could be a company you are involved in now. It could be an old business partner. It could be a family member or an ex-spouse or current spouse. It's really important to know who the insured is and who the owner of the policy is, because the ownership of the policy will determine a number of factors. But the first thing is who has control of that money when it actually comes in, and also the tax implications. So make sure you know who owns the policy. Next, tax implications. I think this is a really important point, because we see in many cases, accountants really focused on getting a tax deduction for the premiums. And that's what the insured hears. They go, I can get a tax deduction for the premiums. That's a great thing. It's going to mean it's cheaper after tax for me. The problem is they don't hear the message, or they don't get the message that the policy, when the amount comes in for a claim, is actually taxable. So if you can imagine, let's say you had a $1 million insurance policy, you got paid $1 million, you're expecting $1 million, but if you're on a 30% tax rate and you got taxed on that, you ended up losing $300,000 and the family only got $700,000. Now, policies are not always taxable, but you need to know so you can take that into account. And you might say, okay, I'm happy with the tax to be paid. I know that's got to be paid if something goes wrong to claim the tax deduction on the premiums, but you may not either. It's about being informed. You need to have a combination of covers, as policies are really narrowly defined. So just going back to what we talked about with Chloe, life insurance, total and permanent disability or TPD insurance, trauma insurance, income protection, and business expenses insurance. For most people, they generally need a blend of all of those or a number of them. And it's really important to have those in place. Now, you don't want to just have life insurance to cover yourself if you die. Death isn't always the worst outcome financially for your family if something happens to you. If you're still around, they've got to pay for your care, if you're totally disabled for the rest of your life. And I'm talking financially here. I'm not talking emotionally or relationship-wise. Financially, that can be absolutely devastating for a family as well. So don't just cover yourself for if you die, and you need a combination of policies generally. The next one, if cover gets too expensive, or you think, I can't afford that, it's too expensive to put it in place, it's not an all or nothing thing. You can actually lower the amount of cover you got. You might say, okay, I need $1 million worth of cover, or I need 100,000 or 10 million worth of cover. Maybe you can't afford that. Well, then work your budget out and say, okay, what can I afford? And then tailor it to your budget. You just need to know what that means to you when you claim. So if you say, look, I can't afford X amount of dollars a year, I'm going to lower the amount of cover I've got, just know what you're going to do if you have a claim and you don't get the full amount that you actually need. You need to know that in advance, so you've got a plan to be able to deal with that. That's what we call self-insurance. So for example, if I need $2 million worth of insurance or life insurance for me, and I choose to only pay for $1 million, I need a plan for if I die, what is my wife and child going to do to be able to fill that other $1 million gap? And that might be selling a property or downgrading a house, various other things. So it's just knowing what they are. And finally, regularly review your policies with someone that knows what they're doing. Your situation's going to change over time. Your debt levels will change, your business will change, As you get older, hopefully you're building assets, policies change, tax change, legislations change. There's a whole raft of things that can change. So you need to regularly review them to make sure the policies are still right. But with the dirty great big caveat, is making sure you don't change things if they don't need to. One of the faux pas I've seen, or one of the major mistakes I see advisors do in the industry all the time, is they will change a policy to get a cheaper policy, but it actually puts the client at risk by resetting what they call the underwriting time. And so just changing a policy to find a cheaper policy isn't necessarily always the best way to go. So that's just a quick summary. Again, with all these sorts of things, it's a very complex subject, and I've just given you some high-level stuff to have a really good think about. Now, you can find Chloe by Googling Findex, Findex, Chloe Arthur, and find her on Google any time of the day. Remember, you can join our new private Facebook group, The Financial Blokes Wealth and Wisdom. And finally, I need to do the reminder again to keep those damn lawyers happy. The information contained in this podcast is general in nature and for educational purposes only. It's not financial advice, and you shouldn't act on the information without appropriate specific advice for your particular circumstances. So thanks heaps again for joining me today, and I'll catch you with a new episode in 2 weeks' time.